this video we're going to be looking at the first of two alternative measures of GDP. So we've discussed that GDP is an inadequate measure of living standards because of the limitations. This is one ways that we can measure living standards, or alternative way we can measure living standards. It's called the genuine progress indicator. Okay, I'm telling you now, if you refer to it as just GPI in your SACs, that will not be enough. You need to say the full name of what it's called. So the genuine progress indicator is the GPI is an attempt to measure whether a country's growth or increased production of goods and services have actually improved the well-being of people in the country. So are we producing more and it's not helping our overall living standards, or are things actually having a genuine improvement in our living standards? GPI is not claimed to be perfect, and we'll discuss the weaknesses of GPI. It just claims to be a better measure of our well-being than GDP. So it came about because people decided that GDP was an inadequate measure of living standards. So GDP does not take into account all changes in society, social welfare or national well-being. So some of the problems with GDP as a measure of living standards is it doesn't take into account how evenly incomes are distributed. It doesn't take into account expenditure that actually detracts from our well-being. So for example, mothers or fathers that are going to spending all their money at casinos. It fails to take into account household work and an incorrect counting of defence expenditure as positive contributions to GDP. So what we're basically saying is if a country is spending, say, $500 million on defence, that will be included in GDP, but it's not really a good thing for a country to have to spend billions and billions of dollars on defending its nation. So, how does the GPI work, or the genuine progress indicator? Well, it starts with a focus on expenditure on goods and services. So it starts with a figure similar to GDP to show how the changes in material living standards. Then what it does is it deducts and adds figures based on whether they subtract or add to our welfare. So it reduces or deducts figures from expenditure that reduce our welfare. So for example, problem gambling, excessive work, unemployment, crime or pollution, or reduced leisure time. So it tries to calculate these figures and reduces them or deducts them from our GDP. So for example, if GDP includes 500 million in problem gambling, that would get deducted from our GPI figure. And then it adds to these figures things that are going to benefit our overall living standards. So if there's lots of money spent on volunteer work, or raising children, or spent on household chores, those things will add to our figure to try and provide a more accurate figure of worthwhile or sustainable growth. And so here's a table that basically summarises how GPI works. And my suggestion to you is, if you're able to define what the GPI measures, explain how it works, and when you're explaining how it works, have in your mind 3 things that get added and 3 things that get subtracted. That will be more than enough for you to get full marks. Okay, so 3 things that get added, 3 things that get subtracted. You don't need to memorise this whole big table. So GPI is, you would start your paragraph by saying it tries to give you a better indication of overall welfare or well-being for society. It does this by starting with a figure like private final consumption expenditure, and then it adds and subtracts figures to determine whether it's worthwhile growth. So you can see here that it includes things like the share of the lowest quintile. So it basically adds the share of the lowest 20% of earners to see how evenly income is distributed. It adds things like hours of household and community work performed each year, or volunteer work. It adds things like contribution of public investment in non-defensive work, so roads. It's adding investment spending to consumption spending. And then it detracts things like idleness of the unemployed, or value of hours of work done involuntarily gets deducted. So some of the easier things are that it deducts things like environmental damage, it deducts things like problem gambling, it deducts things like annual emissions, so carbon emissions would get deducted. All of these kind of things would get deducted. Change in net foreign liabilities, so it kind of gives us a measure of how much debt we're going into. But if you refer to the last slide, and if you look at these column here, it's probably more a clear understanding. So it deducts the cost of crime, it deducts the impacts from climate change, and negative impacts of land degradation, of air pollution, hurting our native forests, noise pollution, costs of commuting, so amount of time spent in traffic. It'd be pretty easy to come up with 2 or 3 things that get deducted, in my opinion. And then things that get added, household and community work is the main thing. Again, the benefits of raising your children get included into that as well. Okay, so you can see by this graph, GDP has been growing at quite a fast rate from 1950 to 2000. But because we were causing excessive pollution, because people were working longer hours, because the overall stress levels are increasing, GPI didn't increase at the same level. It did go up, but not at nearly the same rate as GDP. So there's been an increasing gap between GDP, which doesn't take into account all these non-material factors, and GPI, to take into account the fact that we have things like climate change. We have a lot more stress and a lot of people that are, suicide is more prevalent now than it was in 1950. So based on GPI, living standards have gone from 8,000 to 14,000 from that period, where GDP went from 10,000 to nearly 30,000. Okay? Obviously this is 16 years old now. And the gap is widening due to environmental damage, increased spending on defence, which gets taken out of GPI, reduced leisure, and growing income inequality. Some weaknesses of GPI. Items selected for making positive and negative adjustments are rather subjective, so it's kind of subjective what gets added and subtracted. And some of the accuracy of the data used to make these positive and negative adjustments is a little bit questionable. So it's subjective what gets included, or plus and minus, and some of the data is a little bit questionable. So to finish off, explanation of the GPI. Okay, the GPI is an attempt to measure whether a country's growth or increased production of goods and services is actually improving the total well-being or living standards of society. It doesn't claim to be perfect, it just claims to be more reliable than real GDP. It tries to distinguish between worthwhile growth and growth that actually causes a decline in the quality of life. So how does it work? It uses the GDP data, then makes negative and positive adjustments to reflect the impact on the country's well-being. For example, it deflates or reduces the GDP figure with calculations for the cost of environmental damage, inequality, and reduction of leisure time, and it inflates things like the benefits from volunteer work, raising your children, and performing household chores. So explaining what it attempts to measure and how it works. Next video we're going to talk about the